Hi everyone. So what I've decided is that we will be doing one example from the technical article, the same article which I showed you earlier for life cycle costing and target costing. So that would effectively cover an example for both topics. And if you guys want more practice, you can definitely go to the past papers and you can do more and more practice as well. So this is the example we have. A company is planning a new product. Market research suggests that the new product uh, should sell 10,000 units at $21 per unit. So because this is based on marketing information, so I would assume that this is the competitive selling price. The company seeks to make a markup of 40% markup of 40% product cost. So it means that the profit could be either calculated as a margin or markup. So here in this case, it is supposed to be calculated as a markup, which means on cost. It is estimated that the lifetime cost of the product will be as follows. So in the initial phase, we have in the development phase, the cost is expected to be 50,000. During the production phases, we have the manufacturing cost identified as $10 per unit. And in the decline phase, decommissioning and disposal incurring a cost of 20,000. There is some additional information also given which says that the company estimates that if it were to spend an additional 15,000 pounds on design, manufacturing cost, 15,000 on design, manufacturing cost per unit could be reduced. So as an additional spend, if we can reduce our manufacturing cost. As I said earlier, that target costing and life cycle costing could be used together. That when the competitive selling price suggests that the target cost has to be up to a certain level and the current estimated cost suggests that the current estimated cost is more than that, then we can consider designing out the cost, which if possible here we will consider it. So first of all, let's refer to first requirement. What is the target cost of the product? So what we discussed earlier, if you remember that if you want to calculate the target cost, what you have to do is you have to first of all identify the competitive selling price for that product, which has already been identified as $21. Okay, and then after that we have to subtract certain amount of profit and we will be able to calculate target cost. Now the profit is given in terms of percentage, which means we need to do a quick calculation based on the equation cost plus profit is equal to selling price. Selling price has already been identified as $21, whereas the profit is given as a percentage, 40% on cost. So it means that the percentage for cost is 100, and in turn the percentage for selling price would be 140. So using this equation, we will be calculating profit. So effectively, our amount of profit would turn out to be 21 multiply by what we want to calculate is the amount of profit. So I'll multiply with 40 and divide it with 140, which reflects the selling price aspect. So it turns out that the desired profit margin would turn out to be 6, and effectively the target cost would turn out to be 15. Now this helps us to understand first requirement part A. It then goes on to say that what is the original life cycle cost per unit and is the product worth making on that basis. So as we said earlier, how to calculate the life cycle cost per unit, we will take all the cost which is supposed to be incurred throughout the life cycle and divide it by the expected number of units over the entire life. We will get the cost per unit, which would somehow act as, if you go to the steps of target costing, it would act as an estimated cost. And if that estimated cost is more compared with the target cost, then going on and making the same product would reduce our profitability. So it would mean that it would then not be worthwhile going forward unless we, there is some additional cost on marketing if it is being spent and the manufacturing cost could be reduced. That could be a separate story. But let's first see that whether the estimated cost is more or less than the target cost. So what we will do is we will simply add on all the costs that is expected to be incurred throughout the life cycle of that product. So the life cycle cost, if I would calculate the life cycle cost, which is 50,000 on design and development, and because the expected number of units here, I will assume that production and sale is equal. So I will consider the same number of units of sales as production as well. So 10,000 units if produced at a cost of 10 per unit would incur a total cost of 100,000. And end of life cost also being added. So that would give us a total cost of 170,000. And because the number of units that are expected to be produced over the entire life cycle, as discussed earlier, is 10,000. So it means that our life cycle cost per unit would turn out to be 17 per unit. This is the estimated cost. And as we have earlier identified, that target cost should be 15. Now, if we earlier calculated the profit as $6, right? Now, if the cost per unit is to 17 and the selling price, because we can sell our product at a selling price of 21, so it means that would give rise to a profit of 4. Whereas what we have earlier identified in target costing, that profit should be 6. This is what our shareholders expect from us, right? So if we go ahead, what will happen? What will be the impact on profitability? The profitability will be reduced by $2. It means it is not suggested to go ahead based on financial criteria if we will consider. And now we will move on to third requirement. And as per third requirement, it is being asked here that if additional amount was spent on design of the product, then what is the maximum manufacturing cost per unit? Because it was mentioned that if we spend additional cost, manufacturing cost can be reduced. That could be tolerated if the company is to earn its required markup, which is, we said, 40%. Okay, so let's see if the additional cost is spent on design phase, then what will happen? So now what we can do is, because we are actually going to identify the maximum manufacturing cost. Remember that the target cost is $15, correct? This target cost of $15, it should be covering the manufacturing cost and the other cost, I would say, which is other than the manufacturing, which includes design and development and end of life. So out of 15, let's see how much of it could be attributed to other than the remaining would be attributed to manufacturing. So other than manufacturing cost, currently the design and development cost is 15,000, which is expected to increase by 15,000. And we already have an end of life cost of 20,000, which is further added here. So that would give rise to a total cost of 85,000. Now, this 85,000, if it is spread over 10,000 units, it turns out that 8.5 per unit could be attributable to the other cost. Now, out of 15, which is our target cost, 8.5 could be incurred on the others. The remaining cost, so 15 minus 8.5, the remaining cost is what we can incur here on manufacturing cost. So it means that the manufacturing cost has to reduce to 6.5 per unit. This is what it says. that if additional amount were spent on design, what is the maximum manufacturing cost per unit that could be tolerated? Currently, our manufacturing cost is $10, but we can only tolerate a manufacturing cost of 6.5. So it means that how much is the cost gap that if achieved, we can achieve our objectives. So currently, our manufacturing cost is 10, which is supposed to be 6.5. So it means if we can reduce our manufacturing cost by 3.5, then we could possibly achieve our objective.